Hey everyone, welcome back to the Magic Market, where we bring a little enchantment into financial insights. Today, we're breaking down the top 5 risks of owning Disney stock. Disney is an iconic company with an unmatched entertainment empire, from theme parks to streaming, movies and sports. But no investment is without risk, and Disney has some major challenges that investors need to consider. In this breakdown, we'll analyze the biggest headwinds facing Disney and what they could mean for the stock moving forward. Let's dive in. Before we get into Disney's specific risks, let's talk about why analyzing risks is so important for investors. Every company, no matter how strong, has vulnerabilities. Being aware of these risks helps investors make informed decisions about whether Disney is a good, long-term investment. For Disney, its risks stem from multiple areas: the shifting media landscape, theme park performance, content spending, and economic pressures. While Disney remains a dominant player in entertainment, these factors could impact its stock price, revenue, and profitability. So let's take a closer look at the 5 biggest risks of owning Disney stock right now. The first major risk is the decline of Disney's traditional TV business. Disney owns major TV networks like ESPN, ABC, and Disney Channel. For decades, these networks generated billions in revenue through cable subscriptions and advertising. But today, the traditional TV model is collapsing as consumers cut the cord in favor of streaming. Cable and satellite subscriptions are declining at a rate of about 7% per year, which directly impacts Disney's revenue from ESPN and ABC. Fewer subscribers mean lower affiliate fees, one of Disney's biggest cash generators. ESPN in particular is vulnerable. The network pays billions for exclusive sports rights, but as cable subscribers drop, Disney loses its ability to pass those costs on to TV providers. If this trend continues, ESPN could become a financial drag rather than an asset. Ad revenue is also shrinking. Traditional TV ads are losing ground to digital platforms like Google, Facebook, and YouTube, where advertisers can target users more precisely. This shift is making it harder for Disney's TV networks to maintain their profitability. Disney is trying to adapt with streaming platforms like ESPN Plus and Hulu, but replacing lost TV revenue is not easy. The second major risk? Disney's streaming services are still losing money. Disney Plus has been a huge success in terms of subscriber growth, but it's still not profitable. Running a streaming service is expensive. Content production, technology costs, and customer acquisition all add up. In the past year alone, Disney's streaming division reported losses in the billions. While Disney aims to turn Disney Plus profitable by 2024, achieving that goal requires balancing subscriber growth, pricing strategies, and content investments. Another challenge: competition. Netflix, Amazon Prime Video, and HBO Max are fierce rivals, and they're all fighting for the same subscribers. Disney has strong franchises like Star Wars and Marvel, but retaining customers in a competitive market is tough, especially as price increases could lead to cancellations. If Disney fails to make streaming a sustainable, profitable business, it could weigh heavily on the stock. Disney's theme parks are a major revenue driver, but they come with significant risks. Parks, experiences, and products account for nearly 40% of Disney's total revenue. While demand for Disney's parks has been strong, there are risks that could impact future performance. One major concern is the economy. During recessions or economic downturns, consumer spending on travel and entertainment typically declines. A slowdown in consumer spending could lead to lower park attendance and weaker merchandise sales. Disney also has theme parks in China, France, and Japan. These international locations introduce risks such as currency fluctuations, government regulations, and travel restrictions. If geopolitical issues or health crises affect these regions, Disney's park revenues could suffer. Running theme parks is expensive. Disney faces rising labor costs, maintenance expenses, and capital expenditures for new attractions. If operating costs continue to climb, profit margins could shrink, even if attendance remains strong. The fourth big risk? Disney's high content spending and unpredictable box office performance. Disney is known for its blockbuster franchises, but producing high-quality content is very expensive. Recent films like The Marvels and Indiana Jones 5 cost hundreds of millions to produce, but their box office results were underwhelming. If Disney spends big on movies that fail to perform, it could lead to major financial losses. Additionally, audience preferences are changing. People are watching more content at home rather than going to theaters. This shift impacts Disney's box office revenue and forces the company to rethink its release strategy. Disney also faces competition from user-generated content platforms like YouTube and TikTok, which are grabbing younger audiences' attention. If Disney fails to create engaging content that resonates with today's viewers, its long-term growth could be at risk. The final risk is Disney's leadership and strategic direction. Disney has undergone major executive changes in recent years. CEO Bob Chapek was replaced by former CEO Bob Iger, who returned to lead the company. While Iger is highly respected, his leadership term is temporary, and Disney must find a long-term successor. Investors are also watching Disney's strategic decisions closely. The company has to balance its focus on streaming, theme parks, traditional media, and content creation, all while managing costs. If Disney makes missteps in its strategy, it could hurt shareholder value. Additionally, activist investors are pressuring Disney to make big changes, including restructuring the business and selling off assets. If leadership can't navigate these challenges effectively, Disney's stock could remain volatile. So, should investors be worried about Disney's risks? While Disney remains a powerhouse in entertainment, it faces real challenges that could impact its long-term stock performance. The decline of traditional TV, streaming profitability struggles, theme park vulnerabilities, content spending risks, and leadership uncertainty all create headwinds for investors. That said, risk is just one side of the equation. Disney still has strong brand power, valuable intellectual property, and a long-term vision that could lead to future success. Investors need to weigh these risks against the company's growth potential before making investment decisions. Thanks for joining us for this breakdown of Disney's biggest risks. If you found this analysis helpful, be sure to like and subscribe for more stock market insights. What do you think? Are Disney's risks deal breakers, or do they present opportunities? Let us know in the comments. Until next time, stay smart and stay invested. And stay